Hey, has anyone seen Brandon? He's actually leading the discussion and he's disappeared. So if anyone has Brandon's cell phone number, please call it right away. This is a production of Gassman, Crotty, and Denicolo, and quite frankly, I wish they had better things to do. This presentation will qualify for 1 hour of continuing education credit if you came on through the CPA Academy. If you did not come on through the CPA Academy, then you will not receive credit for this presentation. This presentation is not being given live because I am not alive and I am not paying taxes to anyone for anything. I will, however, answer questions at the end of the presentation, which Gassman and Ketron are unable to do. Okay, please turn your cameras off. We don't want to see your gnarly pajamas this morning. Please take really good notes in case the speakers say anything interesting. And here is Alan Gassman, who will stall for time while we wait for Brandon Ketron, who's really the main speaker. All right, welcome to Saturday, August 27th. The rest of your life just started, and what could be more exciting than income tax aspects of estate tax planning? So when we do estate tax planning, we're concentrating on that $12,060,000 estate tax exemption, which may go to half in 2026, and how to get as much wealth as possible past the estate tax system. And we have many presentations, which you can see on YouTube, on how to avoid the estate tax. But in the meantime, we are faced with the challenge and the odyssey of also avoiding income taxes. And that can be done in many ways in the estate plan, but we often forget to do it because we're so concentrated on the estate tax issues. So again, if you came on through CPA Academy, you will receive a credit hour. There will be 4 polling questions. And if you answer, I think, 3 of them, right or wrong, you'll get your continuing education credit. If you came on through our measly little website, you won't get any education credit. And there is Brandon Ketron. He looks a lot like the dummy, but he actually is not a dummy. And I'm in control of my screen with him. If you have questions, just click on the inverted pyramid and first type in, I have a question dash, and then give us the question, because otherwise we won't know whether it's a question unless you start it that way. Next week, Hamden Baskin is going to join me, and we're going to talk about planning your estate and trust to avoid litigation with true stories, some of which actually happened. And then the following Saturday, Christopher Denicolo, one of my other partners, maybe my smarter one, is going to talk about planning for IRA and pension distributions as he warms up for the talk that he and Brandon will be giving at the Notre Dame Tax Institute. Okay, enough self-promotion. Thank you very much for attending. Brandon, take it away, beginning on lucky page 13.
Yeah, can you hear me, Alan?
No, I can't hear you what you just asked me.
Okay, perfect. All right, so just to kind of start things off here, a lot of what we're going to be talking about involves estate planning and income tax planning tied together. And kind of the main key to remember going into that is, what is the federal estate tax exemption amount? Right now we have $12 million per person, roughly, $24 million for a married couple. You can give away up to $16,000 a year without having to worry about using your exemption, filing a gift tax return. And a lot of these planning techniques, particularly what we're going to talk about first, would apply, and you want to get individuals that are below these threshold levels, because what we want to try to do is use these high exemption amounts while we have them to basically invite estate tax inclusion and therefore get a step up in income tax basis. So that's a key thing to remember. And right now we have an amazing opportunity to do that with such a high exemption amount. Unfortunately, moving forward in 2026, or maybe sooner if the law changes, That's going to be reduced to 1/2 of what it otherwise would be. So the little more families are going to be subject to the estate tax. Maybe we aren't able to do a lot of the things that we're going to talk about with respect to basis planning and when this happens, but still there'll be a lot of older family members that may not have a whole lot of assets that you can take advantage of their exclusion and do some nice income tax planning. So just a few of the ideas that we're going to talk about. I kind of mentioned the first one starting off here of inviting estate tax inclusion to get a step up in income tax basis. Under Internal Revenue Code section 1014, if assets are included in your estate, those get a step up in income tax basis. So one of the things that we can do, say mom or dad has a pretty low net worth, I can put 11 and a half, $12 million of assets into a trust for their benefit, give them a power of appointment over those assets, which would cause, it would have to be a general power of appointment, meaning that they can appoint the assets to their estate, to their creditors, or to themselves. And that would cause the trust to be included in their estate, and get a nice step up in basis, and then it can come back to me or my children. So that's a nice technique to get a step up in basis. Other techniques we're going to discuss: charitable remainder trust to defer income tax planning, income taxes. We can use those. They work very well for deferral of income taxes. They can be used in creative ways to defer income tax for 14, 15 years possibly, and provide a nice benefit to charity, provide a protective trust system for your beneficiaries. So there's a lot of nice ways to use charitable remainder trusts. We're going to briefly touch on retirement plan assets. And the use of some income tax planning techniques with retirement plans. I'm not going to talk a lot about those because I know Chris is going to discuss those in a lot more detail, but I want to touch on a few income tax aspects of those retirement plans. We might get to opportunity zones to use to defer capital gains, entity selection, 199A deductions, use of 1202 stock. We'll see how far we can get along. If we don't get all the way there, we can do a part 2 on another weekend. So Alan, any initial thoughts before we move along here?
Launch forward.
All right. So first polling question of the day. Right now, the federal estate tax exemption is A, 12,060,000, continues to be adjusted for inflation annually, is scheduled to go to 1/2 in 2026. Or, as you might know if you've attended our webinars before, a common theme is the answer might be all of the above.
Okay, so all of you CPAs who are awake, or your cats who answer these for you, please click D, click enter, and then we'll be on with the rest of this sensational program. Are we good, Brittany? Okay, the bell has rung. Go ahead.
All right, so first thing we're going to talk about here is a concept of stepping up basis by using general powers of appointment or some other mechanisms, with the idea being that people that have lower estates, we could use their exemption amount to maybe get that step up in basis. We can also do creative things with some joint trusts that we're going to get into. We're going to talk about how, if you have an existing trust, how you could possibly get these types of powers into those trusts, and some advantages and disadvantages of different types of trusts that we can use. So I did see a question on here, just to go through it. What are we talking about when we say a step up in basis? So when you buy an asset, your cost in that asset is considered your basis, what you paid for it. As the asset appreciates in value and you later sell it, then you pay tax on the difference between your cost basis and what you sold it for. Now, when someone dies, then you get what is referred to as a step up in basis, meaning your cost basis that you paid for it becomes the fair market value at the time of your death. So all that underlying gain that is in there would be eliminated. So you would no longer have any capital gains tax if you sold the asset immediately after receiving it from someone who passed away. For example, my dad purchases Apple stock for $10 a share. It's at $300 a share when he passes away and gives it to me. I can immediately turn around and sell that for $300 and pay no capital gains tax. So how can we do that without losing the asset, having to give it away, having to wait until I pass away to give it to my kids and get that step up in basis? Well, using general powers of appointment is one way to do that. What that means is I put assets into a trust, or I give someone the ability to control where those assets pass upon their death, and make it so that the assets can be appointed to their creditors, to themselves, or to the creditors of their estate, or to their estate. And that causes those assets to be included in their estate, and therefore they would get a step up in basis at the time of their death. So a lot of people do this. It's called, people refer to as upstream basis planning, where they pass assets up a level in a generation to an older family member that may be looking like they're going to pass away, and get that nice step up in basis.
So Brandon, does this have to be under an irrevocable trust, or could this be under a revocable trust? If I set up a revocable trust for me and I can revoke it, but I give Uncle Harry the power to direct assets to creditors of his estate with the approval of my next door neighbor.
Yeah, just having that power over those assets would cause the step up in basis to apply.
Wow.
Yeah, but there is one issue. If you give it to someone and it comes right back to you within a year, then the step up may not apply. So you have to be careful with that. So that's why a lot of times we'll do this with irrevocable trust, where you set it up for your children, you give your father a power of appointment. So then if your father passes away, all those assets held for the benefit of your kids would get a step up in basis.
And that's even though the trust assets are considered to be owned by me for income tax purposes, because I'm the grantor and I retain the power to replace assets with assets of equal value. But if I did this under my revocable trust and Uncle Charlie had this power exercisable in favor of his creditors, I guess when he dies, whatever he doesn't exercise maybe would go into a separate trust for my spouse and descendants, and that would be considered a gift from him and not from me, maybe. Right. As long as I'm not a beneficiary, there's a step up. That's so much better, too good to be true, that I wonder how long this will be out there.
Yeah, it is one of those things that makes you wonder when the IRS, and it's been addressed a little bit in some comments, but so far no regs, no notices, no nothing that would prevent this. But I think it is on the IRS's radar, so it's one of those things, use it while we can and hope it lasts. So joint trust, community property trust, and the Jess trust that Alan was a part of creating are another nice way to plan for a step up in basis. And what these allow to happen is typically when you have joint assets, if one spouse dies, then you only get a step up on half of the assets. The idea behind these community property trust and the Jess was to get a full step up in basis on the death of both spouses. That's the first dying spouse and the second dying spouse. So you get kind of a second shot at the apple on that step up in basis. And that's done, again, through using general powers appointment for the Jess. The community property trust has a nice statutory double step up that can apply. So we'll go through how those work. One of the things that you can do, you have an existing irrevocable trust. Well, if there's trust protectors that maybe have the power to add beneficiaries, you can do this to give someone a power of appointment. Maybe they have the ability to convert a limited power to a general power. If it's looking like the grantor is no longer subject to estate taxes, then we can cause inclusion that way. This can be done through court reformations if need be, if all else fails. But you want to take a look at these trusts, assess the level of estate tax that might apply, and make sure we're not missing out on the opportunity to get a step up in basis. So here's some sample language that you can use to get the step up in basis. Again, the important part is that the power is exercisable in favor of their creditors or the creditors of their estate to make sure we get a step up in basis. Now, one thing that we do want to worry about is discounts that could apply for entities. If we have structures set up to intentionally try to discount entities, Maybe we want to try to unwind some of those structures now if the client's not subject to estate tax. So we get a full step up in basis on those assets rather than a discounted step up in basis. The other thing that might apply here is you give someone basically the right to liquidate the assets for the underlying value, like a put right, and that can also eliminate the discounts.
So let me just mention this language here on page 19. The first sample language is for a client who gave stock away, but wanted to direct where it went when she died. So she was no longer the owner of the stock, her children owned the stock, but they gave her a power of appointment over the stock using this as the core language. And then when she died, they included the stock in her estate. She was under the estate tax filing level, and they took a step up in basis. Now, I don't know if this would work or not, but it might work. So when something might work, then it might be worth trying if there's no downside. The second language is a situation where your client owns 49% of a company, and when they die, you don't want a discount in the valuation of that 49% because you want a high value for a high new income tax basis if the client is not subject to estate tax. So this gives the holder of those shares, those 49%, the ability to transfer them to the company in exchange for an amount equal to 49% of the value of the company in order to eliminate the discount. So that's the language on page 19.
Thanks for that, Alan. All right, page 20 here. The use of independent fiduciaries is an interesting concept, and essentially what this is when we set up irrevocable trust, they're not going to be included in our estate, and typically we would give a beneficiary or a spouse that's a beneficiary the power to redirect where those trust assets go on their death. That can be limited to just my descendants in charity. Significant others could possibly be brought in there if you want to do that for the family. But unless that power is exercisable in favor of creditors or the power holder themselves, it's not going to result in estate tax inclusion, which is a good thing if we're worried about estate taxes, right? But if we have a situation where the trust was set up a long time ago, now there's only $3 or $4 million left in the trust, that's only real assets of the beneficiary. What if we gave someone the ability to convert a limited power that would not otherwise cause inclusion to a general power that would now cause those assets to be included in the estate of the beneficiary, again, resulting in a step up in basis. So what we want to be careful about with that type of planning is, well, now if we give the beneficiary the general power of appointment, they could really kind of screw things up with the plan by directing it essentially anywhere. So how do we protect for that, but still get the advantage of it? And the nice thing is that these things can be limited to only exercisable with the consent of one or more independent parties. So, we set this up, you can have this general power of appointment, but you can only exercise it if it's approved by my CPA and my best friend from college, who is going to approve the exercise to make sure it's not directed inappropriately. And that still results in the step up in basis. So that eliminates a lot of the risk with concerns of being able to direct it really essentially anywhere with the use of a general power. All right, so I think that takes us now to our next polling question. So a general power of appointment is the right to appoint assets to the power holder, the power holder's creditor, the power holder's estate, or creditors of the power holder's estate. It can be conditioned on the approval of specified individuals to prevent unwise exercise. It causes estate tax inclusion, resulting in a step up in basis. Or D, all of the above.
And the correct answer is D, all of the above. And it's interesting that you only need to give the person the power to appoint to creditors of their estate. You don't have to give them the power to appoint to themselves or their estate or their creditors. You could just keep it to creditors of their estate. And then you can provide that it is only exercisable with the approval of a non-adverse, non-discretionary party, which would not be a beneficiary of the trust, would not be necessarily a lawyer or a CPA, maybe your next door neighbor or your best friend from high school. And if you give great grandma those powers, subject to that limitation, nevertheless, when great grandma dies, you can toast her memory and a stepped up income tax basis. And thank you, the polling question is completed.
All right, so slide 23 here. What if we have a trust existing that doesn't have these types of powers? Well, first, one of the things that we can do especially with grantor trust, is typically a grantor trust, which is a trust that all the income of the trust is paid to by the person who set up the trust, and that's done by giving that person the power to substitute assets of equal value with the trust. So let's say that the trust has really low basis in Apple stock, and there's a lot of underlying gain, and me, the grantor of the trust, has cash sitting around. Well, I'm about to die. I see this happening. I see this large underlying gain under this irrevocable trust that may not get a step up in basis. Well, I just swap cash for that Apple stock. So now that the trust has high basis assets and I have the low basis assets, I die, get a step up, pass it to the beneficiaries, and eliminate that underlying gain. So that's one easily tool that you can use to try to do some basis planning as well. Trust protectors, if the trust has trust protectors, that might allow you to install some of these power of appointments or add language to protect the exercise, etc. You could decant to a new trust if your state allows that and the terms of the trust allows that. There's non-judicial modification statutes where you don't necessarily have to go to court to do this, but if all the beneficiaries, the trustee, and the grantor agree, you could modify trust that way. We could actually exercise a power of appointment in the trust to a new trust that would have these types of powers if the trust has that in there that'll allow it. We could go to court and just install trust protectors to give them the power. So we're not necessarily asking the court to do these types of things. We're just asking the court to appoint a trust protector that might have the right to do these things. And then there's disclaimer planning as well that might be used to move assets from one type of trust to another that would be more beneficial. So one of the things that's interesting here is, what if we mess this up and we have a general power, but someone is subject to estate tax? Well, we could save ourselves by doing a formula type clause and say that they only have the power to the extent of their unused estate tax exemption, and then it's going to be applied to the assets with the highest ratio of cost to now current fair market value. So we try to get the most advantageous step up as possible. This is another way you can do this. We have some sample language here that we've used, and then Ed Morrow has a really excellent article on how this same type of language was recently approved in a private letter ruling. It discusses how that is used in his Lissy article, which we've reproduced for you here.
Yeah, the private letter ruling from 2022 was very interesting because there was a irrevocable trust, and there was litigation over the trust by various family members, and they resolved the litigation by agreeing to give an older family member a general power of appointment, but only if the IRS would consent to this not causing any tax issues. So the IRS starts the opinion, which is only binding on this particular taxpayer, by saying, you guys are doing this for a reason. It's clear the reason is to get a new income tax basis. When someone dies, that person's not even a beneficiary of the trust yet. You're going to make them a beneficiary so you can get your step up. And you want us to tell you it won't do anything bad to the trust for GST tax purposes, for income tax purposes. And yes, it will not do anything bad for the trust for those purposes. So it was pretty interesting. The IRS did not say, and you're going to get a step up when Aunt Molly dies, but that's what's happening. It's a indirect approval. Now, if the IRS Home Office knew that this is what the ruling was really about, would they have allowed the ruling to go through? Maybe not. We'll find out if other people ask for the same ruling as the political winds blow.
So one of the things, that you can do with this as well is if you want to put, give assets to a senior generation, that's going to cause a gift to be made. So if I put assets in a trust for the senior generation with the power of appointment, that's going to cause a gift to occur and use a portion of my exemption. So then maybe it's not a great trade-off for using my exemption that could offset a 40% tax to get a step up in basis on some capital gains that are subject to a 20% tax. So the one way you can do this without actually using your exemption is through an installment sale. And if you've been on our webinars before, you've probably heard us discuss this, which is essentially selling assets to a trust in exchange for a promissory note. The trust can have a senior family member with a general power of appointment. So when that senior member dies, the assets underneath the installment sale would receive a step up in basis, and things would continue as they historically do with the installment sale, and that can work well for planning as well. All right, Alan, do you want to talk a little bit about joint trust and how the deaths by the entireties work?
Right. So this is an article. This is from an article that was written in 2013 with Jonathan Blotmacher. And when you talk to clients, do you discuss the step? So if Marcia and I have $10 million worth of assets that cost us $2 million, and I die and she goes to sell the 10 million of assets, what is her capital gains tax going to be? And if we do no planning and we keep the 10 million worth of assets in her name and I die, there's no step up. So she have to pay an $8 million tax on an $8 million capital gain. On the other hand, if we put those assets into a Florida or Alaska or Kentucky or Tennessee community property trust, then we should be able to get a step up on the first death. But in order to do that, we have to sign a community property trust agreement, put the assets in the community property trust, and then if someone gets a judgment against me, they can reach all or half of those assets depending upon what state we use for the community property trust. So the other alternative is we just put all the assets in my name, and then if I die first, which is probably Marcia's preference, then I own the assets. If I leave them to Marcia, but I've owned them at least a year, then she gets the step up. So she'll be less unhappy missing me. But on the other hand, if I leave them directly back to her and I've had them and she gave them to me within a year before I died, no step up. So that's why my trust does not leave everything directly to Marcia. It leaves it to her as trustee of her credit shelter trust, which provides her with what she needs for health, education, and maintenance for her lifetime. So the 1 year look back, we don't believe applies, even though the IRS has said it would apply. So those were the choices back in 2012 when Howard Zaritsky and I were writing an article on joint trusts, and that's when we pretty much designed the JEST Trust. So the JEST Trust, JEST, Joint Exempt Step-Up Trust, might say that while Alan and Marcia are alive, Alan owns 1%, Marcia owns 99%. If there's a judgment against Alan, bye-bye to 1% of the assets, but 99% are safe. But if Alan dies first, he has the right to appoint 100% of the assets, or at least Marcia's 99%, to creditors of his estate with permission of some of their good friends. So then on my death, that funds a credit shelter trust, and the step up, in our opinion, occurs. Now, advantages of the JEST Trust over the community property trust are number one, the just trust can be creditor protected in the way that I described it. Number two, I don't need a trustee in a community property trust state. And number three, then I don't have an annual trustee fee. So that is what Jonathan and I called the step-up basis conversation. Jonathan strongly prefers the community property trust because the step-up basis law is firmer under community property law. That's been around for many years. The jest was just invented. But the IRS instructions to the stepped-up basis rules specifically say that they are not opining on the use of Alaska Community Property Trust, because that was the only community property trust that was available when they wrote the rules. So that conversation, I think, is worth having. On the other hand, if you're going to do a joint trust and it's not a just trust and it's not a community property trust, you might consider a tenancy by the entireties trust or a Delaware or other asset protection trust jurisdiction asset protection trust, but you're not necessarily going to get that step up. Although when Aunt Mildred dies, you may get a step up if you have the Aunt Mildred clause in there. So let's go ahead and do the next polling question. Polling question at page 42. The just trust, A, stands for the joint exempt step-up trust. B allows for a step-up in basis on the first death and then again on the second death, depending on design. C uses what's called a general power of appointment, which is admirable, get it like a general in the Army and an admiral in the Navy, to achieve step up. D, all of the above. And again, the IRS has not explicitly approved the step up with the just trust, but we believe that it works. There are issues that may someday be worked out, but so far, knock on linoleum, no challenges. So Brittany, has everybody entered the answer D, all of the above? Okay. So we have an explanation of the just trust, but not a lot of time. So you could go to YouTube and Google Gassman JEST Trust YouTube, and you'll see some explanations. Brandon, what do you want to cover next?
Yeah, I'm going to flip forward to slide 58 here. So we have just information, community property trust information, and some of the advantages and disadvantages discussed throughout the slides. So one of the things, next I think to mention with income tax planning and estate planning is the use of charitable deductions. So when you have a trust that is a irrevocable trust and a non-grantor trust, meaning the grantor doesn't pay the income taxes on that trust. The trust actually pays its own income taxes or passes out income to the trust beneficiaries, which generally occurs most time after the lifetime of the initial grantor of the trust. So under section 642C, there's a charitable deduction that's allowed. And essentially, it's the equivalent of dollar for dollar deduction for any assets of the trust that pass to charity. Now, there's certain requirements that you have to meet. You can't just arbitrarily send money to charity from the trust. First of all, it has to be made from income produced by the trust. So if you don't have any income in the trust, you don't get a deduction. And it has to be made pursuant to the terms of the governing instrument, meaning the trust has to actually authorize distributions to charity. If it doesn't, then you don't get an income tax deduction. So how does that work? I have $100,000 of income from the trust, from interest or dividends that's payable to the trust. I send $50,000 of that to the beneficiary's favorite charity. $50,000 goes to the beneficiary. Then the $50,000 that goes to the charity is not taxed. It's a tax-free distribution to the charity. You get a deduction. And then the $50,000 that goes to the beneficiary is taxed at the beneficiary's rate. If for some reason the trust retains some of that income, then it's going to be taxed at the compressed trust bracket. So this works well because the beneficiary can then use the trust to direct assets to their favorite charity. It's not subject to any AGI limitations, so you can get a full dollar for dollar deduction for that. So just putting charity in the trust and the ability to use charitable deductions if the family is charitably inclined can be a nice move from an income tax planning standpoint.
So Brandon, let me just add some flavor to this. What we're talking about here is an irrevocable trust that is a separate taxable entity. It's not a trust that I set up that's considered as owned by me. It's its own separate entity. And it has income. And a trust that is separately taxed, we call a complex trust. And if it distributes the income, then it doesn't pay tax. The tax gets paid by whoever receives the income. And if the income is received by a charity that doesn't pay tax, then that is a very nice thing. So let's say you have a client that already gives away 50% of their adjusted gross income, or even 60% of their adjusted gross income all in cash, but they want to give more away to charity and they want to get the income tax deduction. And they have a oil and gas interest that pays them $60,000 a year. So they could put that oil and gas interest into an irrevocable trust for their descendants, and it may also benefit their spouse. Make sure it's a complex trust. The spouse should not be a trustee of it. And then the $60,000 goes into the trust, and the trust gives that money to the charity. Now, if your trust does not specifically say that the trustee can give assets to charity in the original trust document, then it will not qualify. But there is a workaround. You have that trust invest in a partnership. And let's say that the trust owns 95% of the partnership, your client owns 5%. Now the partnership makes the gift, and the deduction will flow through to the trust by K1. Another thing to be wary of is that if you have an active business or income that would be considered to be unrelated business income, if the trust were a charity, then that income may not qualify for this deduction. The third thing I wanted to point out, and I know most of the attendees today are certified public accountants, is this recent 501c4 social welfare contribution of a $1.6 billion business by a politically motivated individual was made public. So a 501c4 social welfare organization does not provide an income tax deduction when he put the 1.6 billion stock in, but there was also no gift tax. It does qualify for the gift tax exclusion. And then once it was in the 501c4, the company was sold for $1.6 billion cash, I believe, and pays no tax. And now the 501c4 can earn more money on the proceeds from that sale and can spend as much money as it wants on social welfare. And what does social welfare mean? Well, it includes giving money to PAC groups, one political party or the other, or backing political opinions, political advertising. So it could come down, it could be a PAC for abortion, a PAC against abortion, a PAC relating to immigration, and Uncle Sam is subsidizing this. So that's what the CPAs need to know about 501c4 social welfare organizations. And if you have a client that's going to donate $300,000 to a political candidate or a PAC, maybe have them put $1 million worth of assets in a social welfare organization. I'm sorry, have them put $1 million worth of income producing assets into a complex trust. That's not going to get them the deduction, but have them put those income producing assets into a social welfare organization, and they can use part of the money for the political purposes and then part of it for the welfare of their community. Brandon, anything to add to that?
Yeah, no, that's really kind of an interesting concept, and sounds a little too good to be true, but I guess it works. So it's Definitely interesting for sure. So different ways to give money to charity. We're going to talk a little bit about the Charitable Remainder Trust in the future slides. Qualified charitable donation, a QCD, is a nice way to save some income taxes as part of your estate plan as well. If you're giving money to charity, give it to the charity directly from your IRA. You can do this up to $100,000 if you're over the age of 17 and a half, I believe. And just direct the RMD instead of taking it individually, paying tax on it. You direct it to a charity up to $100,000. It has to be a public charity. It can't be a private foundation. It can't be your donor advised fund. So there's some restrictions there. But if you're giving money to a public charity, that works very well. You can use IRA beneficiary designations to give money directly to charity or private foundation. You get an estate tax charitable deduction for those amounts, and you also would not pay income tax on those amounts when they come out of the IRA. Charitable gift annuities could work. Again, has to be with a public charity where you get, you say you're going to give an annuity to charity over a term of years, you get a deduction for that actuarially calculated amount based on the present value of that. Charitable lead annuity trust can also work similar to kind of the inverse of the charitable remainder trust, where I give money to charity for a term of years and whatever's left can pass to a trust for my descendants. This can actually work great for estate tax planning. You can actually set this up to zero out in estate tax. So anything in excess of my estate tax exemption goes to a charitable lead annuity trust, or a CLAT as it's called, and pays charity for a term of years, and then whatever's left at the end of those years goes to my beneficiaries. Generally, there's a pretty low interest rate that you use to calculate what's considered to be going to charity. So the assets, to the extent they produce appreciation in excess of that interest rate, can benefit your descendants. So CLATs work very well for estate planning. You can also form them during lifetime and get a income tax deduction as well for funding those types of trust. Okay, so briefly, I want to cover charitable remainder trust. We have separate webinars that go through this. I think Alan and Jerry Hesh did one recently that's on YouTube that will cover this in a lot more detail. But the idea behind a charitable remainder trust is I put assets into the trust. I get an income tax deduction for placing those assets in the trust equal to around 10% of the fair market value, typically is the way it's structured of what goes in. So I put $1 million in. It has low basis, so let's say zero basis, so $1 million of underlying gain. I get a 10.875% annuity back from that trust for 20 years. And because of that, there's considered actuarially around $10,000 going to the charity. So you get a $10,000 income tax deduction. You sell the asset for $100,000. You pay no tax while it's in the CRUT. When payments come out to you, you pay the tax at that point in time. So under this scenario, rather than paying all the capital gains in year one, you could spread it out over a term of 20 years and kind of defer that tax out over a number of years. It could also be set up based upon your life expectancy, so that the tax would be spread out over your life expectancy. So another way to do this is a CRAT, or charitable remainder annuity trust, where instead of getting a percentage of value, you get an actual dollar amount of value. Typically, most of these are structured as CRUTs, where you have a unit trust percentage. Works out generally better for the client that way, but I wanted to mention the CRAT as well to bring us to our final polling question of the day on the types of charitable remainder trust that can be set up, either a unit trust or an annuity trust, or possibly both.
So the best answer is C, but you can't go wrong with A or B. Notwithstanding whether HBO or Disney took away the Sesame Street talk that covered A, B, and C. Okay. Let me mention, I want to go back here and mention that for, I think, every one of these things, you can get the best result by supporting a public charity or a operating foundation, which can be a private operating foundation. And for charitable clients, not transferring $100,000 a year from the IRA of someone who has reached age 70 and a half directly to a private operating foundation, that would be a mistake, because you satisfy your minimum distribution rule with up to 100,000 a year, and that's a very good tax deal. Now, with the charitable remainder trust, you only are giving 10% in theory away. You can keep 10.8% payments for 20 years, and what's left goes to charity, and the charity could be your children's foundation that they would have to operate for charitable purposes. But in the meantime, you can defer the income tax for the assets that are under that charitable remainder trust for up to 20 years. And most likely, if you use an aggressive flip NIMCRUT, which is described in some of our other videos and certainly in literature, you really don't have to take anything out of that trust until about the 14th or 15th year if you want to maximize what comes out of there. So when you have a client who's about to sell a big building or a big business or a big stock position, and you explain that if they don't have to pay income tax for 15 years, how much more they will have, and that a large portion of this goes to the charity, which can be run by their children, they will quite often get on board and do a charitable remainder trust. And then if they're estate taxable but charitable, they can do a charitable lead annuity trust right now and get 100% income tax deduction for what they put into it, even though a lot of it will flow to their children later. So you get the income tax deduction now for a tree, and then at the end of the day, in year 20, a big part of the tree goes to your children, even though it was never in your estate and it was never subject to a gift tax. There can be a lot of income tax savings there. So Brandon, what did you intend to cover next?
Yeah, let's skip to, let's see, the IRA slides. I know Chris is going to cover IRAs in a lot more detail in 2 weeks, I believe, but I did want to mention one thing, because I think Chris will probably cover a lot of the new rules from the proposed regs, but I wanted to mention an income tax planning idea with the use of a teapot trust, which is an estate planning technique that you can incorporate after the death of the IRA owner. So now you know that under the new proposed regulations, we have, or actually under the Secure Act, we have this issue where if we don't leave assets directly to or to a trust for the sole benefit of certain beneficiaries, the surviving spouse, a minor child, a disabled or chronically ill individual, that those assets have to come out of the IRA after 10 years. So when this first came out, we sat down and we were thinking about this and said, well, if everything has to come out within 10 years, now we no longer necessarily care about, oh, we lost the slides. Let's go to 137, I believe, Alan. If the IRA assets have to come out, in 10 years, we don't necessarily care about having multiple beneficiaries of this trust, differing in age, groups under the trust. We can simply leave all these assets directly into one big pot trust, and then we can look at the respective tax brackets of the beneficiaries and try to type 137 on your keyboard and see if we'll flip to it there. There we go. So we can, give the trustee discretion to kind of spray out income to different beneficiaries at different tax brackets and really try to minimize that income tax effect of, the IRAs that are always going to be subject to tax when they come out of the IRA and come out of the trust to the beneficiaries. So how can we do that in the most tax efficient manner? So, an historical plan here would be 3 separate trusts for each child. Everyone gets 1/3 of everything, but child 1 is in the 40% bracket, so he pays a high tax. child 2 is a school teacher, so they're in a lower bracket, and then 1 just doesn't have hardly any income at all, so they're in the extremely low bracket. If we left everything equally, at the end of the day, the beneficiaries end up with different amounts after tax. It's not really the most tax efficient. So how can we make this more efficient? And our idea was, well, the IRA is payable to this teapot trust that would then pay out income to the low bracket beneficiaries. But to make sure everyone's still treated equally, we have this separate equalization trust with non-IRA assets that would then even everyone up after all the IRA assets are distributed. So for example, here we have the teapot trust holding the IRA assets give the school teacher $10,000 a year for 10 years and gives the non-self-supporting individual $70,000 a year for 10 years. So that, minimizes the income tax by, making them in that lower bracket. We can't give it to them all in 1 year, because if we gave them $700,000, they'd have $700,000 of income and be in the high bracket. So we spread it out over the 10 years to make sure they stay in that low bracket. So then at the end of the day, after that 10th year, we use the equalization trust to even up child 1, so he gets a larger distribution from that trust. Child 2 gets a medium distribution, and child 3 gets a small distribution from the equalization trust. So at the end of the day, after 11 years, everyone is treated equally. They've received the same amounts after tax, and we have now saved the client a good amount of income taxes. So we look at the differences here with a $900,000 IRA, around $4 million in total assets at the end of the 10th year. Using the teapot trust system gives us 4.66 roughly, and then without the teapot system, 4.57. So about $100,000, a little over $100,000 difference there for use of the teapot trust system. So that's a nice creative way to use flexibility of a pot trust to spray income out over different levels. The other thing to mention with IRAs is the use of a charitable remainder trust. So rather than leaving the IRA to the person individually or to a trust for their benefit, and everything would come out in 10 years as one lump sum, we can use a charitable remainder trust to try to mimic the old rules where it's payable over their life expectancy. So here we have an example of the 10-year rule that would apply if we left it to just a adult child, where everything can cook for 10 years and then come out as a distribution. You pay tax at that time. We have the net amount to the beneficiary, and then they reinvest for a number of years, and we have our ending balance. So how does that compare to the charitable remainder trust, where the IRA would be made payable to the charitable remainder trust? The trust would receive the IRA, invest it, the full amount without paying tax, and then distribute around 10.875% each year for 20 years to the beneficiary. So smaller amounts come out to the beneficiary each year. Tax is paid as the amounts come out of the charitable trust. So where does that leave us at the end of the 20 years compared to the 10-year rule? Well, just slightly lower, around $200,000, $300,000 difference. But we have a nice benefit to charity of around $450,000. So when we combine those, we actually get more money out by combining the charitable beneficiary and our non-charitable beneficiary. And the assets are kind of distributed out a little more evenly. They maybe aren't wasted with one big lump sum distribution like could occur under the 10-year rule. So you can sacrifice a little bit of gain for the individual beneficiary for a more protective type structure. And then also, if you're charitably inclined, this works out even better than just a straight 10-year rule.
So Brandon, can I set up a trust which would say my IRA will go 1/3 to each of my children, but if a child disclaims it, then it will go to a charitable remainder unit trust for the child, or if the trustee of the charitable remainder unit trust disclaims it, then it will go to a public charity and receive 100% tax-free treatment, then indirectly directed by my child.
Yep, absolutely. That's nice way to use disclaimer planning to give the client and the beneficiary some options so they can, within 9 months after the date of death, kind of decide where they want things to go. Do I want to get it directly? Do I want to do this charitable remainder trust? I don't really care. I don't need the money. Let's just give it all to, the Salvation Army or some other public charity, for example. So that could definitely be a useful plan.
So a typical disposition that we sometimes see or that we draft is, I hereby leave $1 million to my daughter and request that she disclaim this devise and allow it to go to the XYZ museum. But if my daughter would prefer to receive the disposition and then donate her own money to the museum, she would feel free to do so. So now the daughter, if there's no estate tax, the daughter gets the $1 million, and then she can go ahead and transfer her own appreciated assets to the museum over time and get nice income tax deductions as opposed to a direct disposition to the museum. When you deal with disclaimers, make sure that you understand that a person who disclaims, you have 9 months to do it pursuant to Code Section 2518. But if you will benefit from making the disclaimer, it won't work. So you need to say, this is payable to my daughter. If my daughter disclaims it, it will go to the Charitable Remainder Unitrust. If the trustee of the Charitable Remainder Unitrust disclaims it, not my daughter, but the trustee of the Charitable Remainder Unitrust disclaims it, then it is going to the charity. But I made a mistake, because I shouldn't have said it's payable to my daughter and if she disclaims it. I should have said it's payable to a trust for my daughter. And if the trustee of that trust in his or her fiduciary capacity disclaims it, then it goes to the Charitable Remainder Unitrust for my daughter. And then if the independent trustee of that trust disclaims it, then it goes to the charity. And
Yep.
we also do that with charitable lead annuity trusts. I don't want to pay estate tax, so I leave it to my daughter, but if she disclaims it, it'll go to the CLAT for her benefit. Nope, that doesn't work. I give it to the lifetime trust for my daughter. If the trustee of that trust disclaims it, then it goes to the CLAT for her. If the trustee of the CLAT disclaims it, then it goes to the charity. So then the client dies, and the daughter and her advisors can advise the trustee within 9 months of date of death which of those work best, and that can involve IRA planning, which has nothing to do with the Irish Independent Army or whatever
Yeah.
that was.
And just to touch on why that doesn't work if you leave it directly to the child is if you disclaim an asset, you can't benefit from it after you disclaim it. So that's why we would have the trustee execute the disclaimer rather than the child as the beneficiary directly. So Alan, I think we're running a little bit out of time here, but I think I'd just give a preview for maybe what can become part two of this presentation. So we wanted to talk about opportunity zones and how those can be used. So this will just be a little bit of a summary on opportunity zones that you can look at and how they can be used. Some basic income tax operation for trust. There's grantor trusts where the grantor pays income taxes on the trust. There's complex trusts that are separate taxpayers. There's SBIT trust, electing small business trusts that own S corporation stock. That's going to be, if you have any S corporations owned by trust, they have to be owned by a grantor trust, an SBIT trust, a Section 678 trust, which is a trust where the beneficiary actually pays the taxes on the trust rather than the trust itself. And then, or a qualified subchapter S trust or a QUIS trust, where there's only one named beneficiary, all the income of the trust is paid out to that beneficiary, and therefore all the S corporation income is also taxed to the beneficiary of the trust. So there's just a little refresher on what can own S corporation stock. We have a lot of details on SBITs and QUIS. We want to talk about maybe Section 199A planning with the use of trust in our next webinar, and how you can use complex trust, possibly if you can get around the proposed or the actual final regulations now that limit some of their uses. use of 678 trust in 199A planning as well are covered in the slides. How 199A planning and estate planning can kind of coordinate together to maybe, again, try to take advantage of some lower income tax brackets of beneficiaries that get you below the 199A threshold. So even if you have one of the tainted specified service trader businesses or not enough wages or qualified property, you might be able to get around that by a lower income tax beneficiary of a trust. And then finally, a little bit about section 1202 in the slides and how that can be incorporated into an estate plan as well, which allows you to sell C corporation stock in a small business under 10 million generally, income tax free if you meet certain holding period requirements. So Alan, I'll kick it back to you to close this out.
Well, why don't we look for questions and answers, Brandon?
All right.
Do we have any questions and answers?
We do have a lot of questions. Let's see, let's pick out a few good ones here.
Yeah, I mean, I think if you're a CPA looking for credit, you're done. You've satisfied your requirements. If you're interested in what the questions were that people asked and getting answers, you're welcome to stick around. I don't have any more jokes, though. There is a cat in Connecticut who asked a question that we'll be getting to, but go ahead, Brandon.
Yeah, so here, can the JES be established in all states, or is that just Florida? And the JES can be any state. You don't have to worry about, it's maybe a little bit harder to accomplish in states that have separate estate tax, like maybe Massachusetts. It just gets complicated in that scenario. It can still be done, but there is a lot more complexity if you have a state estate tax that's separated from the federal estate tax. Let's see. Please discuss a step up with slats or lack thereof. So I think that's a question. You can use power of appointments like we talked about with the slat, just as well as you can with any other type of trust. There's also consideration if the slat is a grantor trust for income tax purposes, that it might also get a step up in basis. I believe we talked about that in some prior webinars, and we have some articles that we could share as well on the position that a grantor trust gets a step up in income tax basis. Essentially, it comes down, in our opinion, to the fact that the grantor is the owner of the assets for income tax purposes. The step up in basis is an income tax concept. If I'm treated as owning them on my death, then I should get a step up. And there's probably just as good a shot that you get the step up as you don't get the step up. So it might be one of those things where you take the position and discuss it with the client, the risk involved, and see if you can get a step up. There's also been proposed bills passed that would prevent the step up for grantor trusts. So that kind of is a little bit of evidence that the IRS thinks that there may be a realistic shot that you actually do get the step up, or else they would not be passing laws to try to prevent it. Let's see if I got some others here. Question on the installment sale planning to a defective grantor trust, should the promissory note be secured? We typically make it secured by a pledge of the asset sold, just to try to make sure it's as arm's length as possible. I think that's really the reason why, is to try to make it fair market equivalent terms that you would see in a typical M&A transaction, which would always most likely involve some type of security for the note.
What are the advantages and disadvantages of setting up a charitable foundation versus a trust? Well, with a charitable foundation or a charitable trust, you can get an income tax deduction for setting it up and for funding it. And with a charitable foundation, you would get recognition from the IRS that you're a bona fide charity. The benefits of a trust is that it's less expensive and burdensome to manage a trust versus a charitable foundation. And that with a trust, you can use the complex trust rules to give away more than 50 or 60% of the client's adjusted gross income. But somebody who's really charitable would probably do both of those things.
Yes, here's another one. Can you take additional funds from an IRA to generate more taxable income? That can be offset by charitable deductions, irrevocable and an irrevocable trust. So on the irrevocable side, a complex trust, a trust that's its own separate taxpayer, it's paying its own taxes. Yes, you can distribute money from the IRA, triggering income, which would then be distributed to charity, getting the charitable deduction, as long as you have appropriate language in the trust on the allocation of income, making sure IRA receipts are considered as income. Most states have that by default under state law, but just make sure that you're covered there, because if the trust doesn't deem it as income, then it's not going to be income and therefore no deduction. On the revocable trust side, that's going to be a little bit harder, and grantor trust side as well. If the IRA is made payable to those types of trusts, then that's income of the grantor individually, and then a charitable deduction from an individual standpoint, which would be limited by adjusted gross income limitations. So you can still get a higher deduction. It's just going to be basically a higher percentage and not a full 100% deduction like you can with a complex trust that pays its own taxes.
Okay, then why would a beneficiary disclaim? And the answer is a disclaimer is really a choice. So you have choice number one, because the trust says it's going to go this way, but if the trustee receiving it disclaims it, then it's going to go that way. So the beneficiary would want to take that choice. And then would the disclaimer by a trustee be a breach of fiduciary duty to the daughter in Alan's example? And the answer is not if you have properly drafted that the trustee has a discretionary power to benefit both the daughter and the charitable remainder trust that is the next beneficiary. So the next question is, would you need court approval for the trustee to disclaim? And the answer is no. You could go get court approval if that makes you feel better, but you should be able to draft this so that you would not need court approval for a child to exercise the disclaimer. The next question is, what's the best way to leave property and brokerage accounts to a child and then a grandchild? The answer to that is usually in trust, because if you just leave it to the child and say, oh, when you're done with this, give it to the grandchildren, well, the grandchildren may not be seeing anything. So if it goes into a trust that's creditor proof, estate tax proof, and maybe even bad decision proof by having a co-trustee serve with the child, if the client is charitable, then it could be a long-term charitable remainder trust, or it could be a charitable lead annuity trust. But leaving things outright to children is usually not a good decision. And you may think your children are very trustworthy, and they may lead you to believe they're very trustworthy, but when the going gets rough, the rough assets may be going. Then there's a good question here. How would you structure a charitable deduction trust to avoid the situation that the Paul Newman family is facing? So the Paul Newman family is facing a situation where the business, the salad dressing business, admirably went to a foundation, but under the Internal Revenue Code, the section that they used for this requires that the foundation be controlled by people other than the family. And I think the Paul Newman family's advisors didn't realize that he could have put 1% voting stock into a trust that only benefited his immediate family as to 35% of the trust assets. 65% could have been for the welfare of general mankind, or for cousins or charities. And then he could have left the 99% membership interest in the company to a family-run charitable organization, which could operate a school to be qualified as a public charity. And then the children could be completely in charge of all that. So if you have a client that wants to leave the business all to charity, don't use the Paul Newman exception. You can use the salad dressing, although it's 100 calories per tablespoon. So I'm not, not crazy about that either. But if you could just, like I said, put 1% voting into a 65-35 trust, or you could put it into a social welfare organization, a 501c4, and then the other 99% gets run by the family. Now, I don't know Paul Newman's family. He never invited me to his house to meet them. But maybe they're not very trustworthy, and it was better that this go to independent third parties. I don't really know. Brandon, what do you have?
Yeah, so the last one I got here is what happens if a beneficiary does not take the full amount of a CRUT distribution for the year? So I think it depends on how it's structured. If it's you can draft it to where you don't have to take the distribution if it's a NIM-CRUT, which is net income with makeup. So essentially that says you take the percentage that would be distributed, compare it to the income of the trust, and you take the lesser of the two. So if there's no income, then there's no distribution, and it's just banked up and distributed in future years. But if it's just a straight CRUT, right, and you're paying out 10%, for example, annually, and you don't take it, then I think there's risks that the CRUT could be disqualified. There's probably penalties and interest owed in the next year for not timely taking the distribution. I don't recall off the top of my head what those penalties are, but I know they're significant. So make sure you're complying with the CRUT aspects and and following the rules appropriately if you do set up those types of trust.
So here's the last question, and I certainly identify with this question. It's a great question. I have a client who almost died and does not like to talk about trust and has a large estate. Any thoughts? Well, how to lead the client to water and get the client to drink is a very big issue for a lot of us with a lot of clients. Sometimes you have to yell at the client. Sometimes you have to get the client in a room with 3 or 4 people who can help convince the client what to do. Sometimes it takes alcohol. Sometimes you go out to dinner with the client or a happy hour, and maybe after their 3rd drink, they're starting to be more logical. But if you can use a little bit of psychology, dig into their mind a little bit, and figure out what their hottest motivator is. It may be a hatred of a person that they need to defend their estate from. It may be resentment that the IRS is going to take estate tax. It may be that they want to feel really important by giving a building to a charity, or they want to impress their brother-in-law. But whatever that motivation is, you need to bring that in and show how your estate planning is going to solve the problem. And when all else fails, yell at them and see if that works. So, and sometimes, quite honestly, what you have to do is educate the spouse and say, hey, Floyd just gave you a durable power of attorney. If Floyd ever starts getting confused, give me a call and we'll handle the whole estate plan by you signing under his power of attorney. So what I want to say, though, the person who asked me that question and those of us who have these clients who desperately need to do things and refuse to, just keep working on them, try everything, and something might work. So speaking of something might work, I hope the rest of your weekend is even a small portion of how good this presentation just was. Thanks to those of you who stuck around. About 30% of the people left immediately at the 1 hour mark. About 70% are still here. We'll keep doing this every Saturday at 11 o'clock until you're all gone. Please let us know your questions, comments, and suggestions, and have a great rest of the weekend. Brandon, any final words?
Yeah, no, I'm good. Everyone enjoy your weekend, and we'll see. I'll be back in, I think, a couple of weeks, and Alan will be back next week with Hamden for another topic.
Okay, thank you. And thank you, Brittany, for working every Saturday, whether you want to or not.